worse than payday loans? So over the last 2 or so months, there's been a number of articles that have been coming out about where the payday loan volume that some Democrat politicians went after. Remember, there was a lot of people going after, a lot of congressmen, a lot of financial education, consumer advocates here in the United States that were going after the payday loan companies. The large U.S. banks had investments in all these payday loan companies. The payday loan companies were charging sky-high loan shark interest rates, sometimes I think triple digits. And of course, they were very profitable to the banks and the payday loan companies, and they were unfortunately taking advantage of very desperate people and people without much of a financial education. And they did manage to shut down or regulate. I'm not in favor of regulation, but unfortunately a lot of people need to learn financial education for themselves, and that's just not the society we live in now, where a lot of people take responsibility, a lot of adults take responsibility for their actions and try to learn from their mistakes. We just really don't live in that society anymore. There's a very small percentage of people who do that now. So there's been, like I said, articles that have come out in the last 2 months. There was a Wall Street Journal article that came out at the end of September called "Eyeing That Sweater. It's Yours in 4 Easy Payments. Fintech Firms Pitch Installment Plans to Consumers Increasingly Reliant on Borrowing." And that article, I guess the Wall Street Journal, I see it's here for free now, that Sean Gauthier wouldn't think of using credit cards to buy sneakers. I try to save them for emergency situations. I guess he's a 38-year-old nightclub manager in New London, Connecticut. If I start online shopping with my credit card, I'll start getting nutty. But a lot of people already have a lot of credit card debt because the U.S. consumer, in my opinion, is pretty tapped out. A lot of people have not gotten a lot of wage growth. Now, the official U.S. government data is saying that there is some wage growth, but not everyone has gotten the wage growth, and it's in disproportionate amounts. And there's been a ton of stagflate and tax and lie since 2008. There was obviously some before that, but it's really accelerated, and the government inflation statistics are not covering that. The Chapwood Inflation Index covers that a lot better, from Ed Butowski, and it's more accurate. It's based on John Williams of ShadowStats, his numbers. So John Williams of ShadowStats has his calculations, which are the old inflation data that the Fed used to use a couple decades ago. It was more accurate with inflation data. And the Chapwood Inflation Index, which is free, you can look at it. It says that inflation is between 8 and 13.2% per year in most major metro areas in the United States. So this article, recently while browsing a $140 pair of white, pink, and green Nikes on the app, I guess he collects these expensive shoes, footwear retailer StockX, never heard of it, he tapped on an offer from financial technology upstart Affirm Inc. that let him buy the shoes right away and pay for them over 6 months. He could have bought the colorful kicks outright, but Mr. Gauthier, who has used Affirm several times, said the $5 the companies charged him in total interest was a small price for flexibility to pay over time. But you're going to see, after I read this other Bloomberg article that came out in the last 10 days, that a $5 charge is nowhere near the amount that a lot of people are getting charged for these online installment plans. And these online installment plans, the amount of them just in the last 4 or 5 years, the amount of loan volume of online installment plans, according to this Bloomberg article that I'll read after this one, the online installment plans are up about tenfold the amount of loan volume in just the last 4 or 5 years. So all those payday loans that got blocked by some Democrat politicians and consumer advocates. And again, I'm not in favor of regulation because I don't think regulation really solves a lot of problems. I know a lot of federal government regulators, and I've heard a ton of crazy stories. People have to take more personal responsibility for their screw-ups and their actions. They need to focus on a financial education and have more common sense. Develop savings. Look, if you're paying, as bad as credit cards are, if you're paying 18% interest on a credit card, but you're getting charged 100, triple digit loan shark, 100% interest or more on these online installment plans, which one do you think is better? Okay, the people are going to say, well, at least I can make the payment, but you're on an online installment plan because it's low, but you're not paying back any of the principal amount. You're only making the absolute minimum payment. You're not paying back any of the principal, which means that principal, the interest is being charged, it's being accrued, accumulating. It's negative compounding. It's real bad. I wish this was taught in schools. It's not. I would argue it's being intentionally not taught in schools. That's why I want to start that's why I have the full business plan for my educational technology company. There's a large component in there with personal finance stuff, the basics. We have advanced stuff in there in the business plan, but there's also classes for the basics. It's not being taught in schools. It's intentional. Okay, back to this article. So this guy was lucky. He only got charged a $5 fee. In total interest, small price for flexibility to pay over time. Gone are the days when special financing plans were mostly reserved for big ticket purchases like TVs and refrigerators. Now sweaters, makeup, or other everyday items can be paid for on installments with loans or other payment plans offered at checkout with thousands of merchants in the US, including Walmart, Urban Outfitters, and soon H&M. Some Amazon Incorporated credit card users can also sign up for these plans. Merchants and lenders are tapping into the financial challenges many U.S. families are facing despite signs of a strong economy, which this Wall Street Journal article claims I would disagree with. Low unemployment. Yeah, there's low unemployment because people have to work a full-time job and a part-time job or multiple part-time jobs in order to make ends meet. So it's not a strong economy because there's low unemployment. There's low unemployment because people are having to work more and more jobs, a full-time job and a part-time job, or a couple part-time jobs, or multiple side hustles just to make ends meet. That's the truth. Okay, consumers are increasingly relying on borrowing to fund their daily lives. 100% agreed. We know this with credit card debt. The amount of credit card debt last year, it went up, I think, a record amount, over $800 billion in 2018. Over $800 billion 2018, an enormous amount. U.S. consumer, so this is going to mean less discretionary income for the consumer. There's a lot of signs that the consumer is being tapped out. The consumer is overwhelmed with higher cost of living increases in most major metro areas, with stagflating tax and lie, more currency devaluation, even though the dollar is rallying against other fiat currencies and taxes. And in order to try to maintain their standard of living, people are going to borrow. But that means less discretionary income for the consumer. So the consumer's trying to make up for this with credit card debt and these online installment plans. So the U.S. consumer debt is higher than ever as cars, college, housing, and medical care grow more expensive, but income stays largely stagnant. The payment plans often resonate with young adults who are wary of carrying credit card balances after watching their parents struggle with debt during the last recession. The payment plans are also debt too, especially you'll find this out in the Bloomberg article. Financial technology companies such as Affirm, Afterpay Touch Group, and PayPal Holdings dove into these payment plans after that period when banks pulled back on consumer lending. Growth is booming. Affirm's point-of-sale loans doubled to about $2 billion last year and are expected to at least double again this year. That is unbelievable growth. Chief Executive Max Levchin said, so that type of growth is going to attract the big banks as investors and other investors looking at that growth. Reliable industry-wide statistics about the size of this market are hard to come by, and it is tiny compared with the roughly $450 billion of spending limits on new U.S. credit cards that Experian says were issued last year. But more than half of the merchants surveyed this year by advisory firm 451 Research said they already offered installment options or plan to adopt them in the next year. Nearly 40% of consumers surveyed said the ability to finance a purchase at checkout made it more likely that they would complete a transaction. So if you're not familiar with history and consumer credit, I believe these installment plans started with like Sears and Kmart very, very long time ago. I think Sears was the first one to offer it when they had their mail-in catalogs. So it's been around for a while, and it wasn't popular, the installment plans. Like, they had them, but there just wasn't a lot of demand for them, especially as credit cards became more popular. But now, because the real economy is not as good as the government statistics claim, there is more inflation, there is more taxes, a lot of people are struggling to make ends meet who don't own a lot of assets, who have not benefited from the last 10 years of rising prices in stocks, bonds, real estate. My generation and younger, people who are in college or just graduated college, they have not benefited from the asset price inflation, the wealth effect that the Fed did. So that's why they're looking at, more and more credit, even though they shouldn't be, because they're desperate. So big financial, okay, but more than nearly 40% of consumers surveyed said the ability to finance a purchase at checkout made it more likely they would complete a transaction. Yeah, but that means they're going to end up paying a lot more if they're financing the purchase, depending upon the interest rates they're paying. Big financial companies eager to expand their consumer lending are jumping in. JP Morgan and Citigroup, American Express, as well, have introduced or are working on payment programs for cardholders that resemble installment plans. Some consumers, like Mr. Gautier, have credit cards but prefer the structure of point-of-sale loans. Interest rates are often lower. This is not true anymore. They're looking at only part of the market. I'll talk about the Bloomberg article in a couple minutes. The loans last for only a set, relatively short time, and borrowers also generally know upfront how much they're going to pay in total. Say a borrower buys a $100 outfit with a credit card, he will need to pay that off by the next due date or carry a card balance, which can last months if he makes only the minimum payments and racks up interest charges. With an installment loan, he pays a fixed amount with each payment, say $25 each month over the following 4 months or more, depending on interest or other charges, and knows ahead of time what the total will be. In some ways, the offerings echo layaway plans that were popular in years past, though in those cases, the buyers didn't usually get their item until after they had made all their payments. Some borrowers say the installment plans force them to be more disciplined after paying back the money, and that they feel like they have more control since they're borrowing for a specific item. When you put something on a credit card, it vanishes into a big black ball of debt, said Guy Stevens, who has paid for a vacation and mattress using Affirm. There are balances I've had over time where I don't even know what I bought. Larger purchases can require relatively big monthly payments. For example, a borrower who makes $400 in purchases might have to pay it back in $400 installments. With a credit card, the minimum required payment each month would likely be much smaller. Yeah, so you don't pay off the balance on a credit card and you get charged more interest, and then that interest increases the size of your balance because you're only making the minimum payments. I really wish, I'll say this again, I really wish this would be taught in schools. But the government school system is broken. It does not teach the financial education needed at the high school and college level that you need to be a successful and productive adult in society. These plans are generally, even the finance classes, especially the economics classes, these plans are generally offered to customers while they are browsing products or about to purchase an item, often online, but sometimes in stores as well. Retailers hope such services will draw in new customers and prompt them to spend more. The fintech companies typically collect money from merchants for each sale. As with credit cards, the loans are unsecured, which means lenders generally can't repossess particular items if borrowers fall behind on payments. Borrowers can be referred to debt collectors. Some borrowers use the installment loans because they don't qualify for a credit card or they've maxed them out. Some of the companies providing the loans review non-traditional data about borrowers. For example, a firm at times reviews applicants' bank account balances. Heidi Pracer said she was rejected for several credit cards after she fell behind on bills. While shopping for a mattress on Purple.com, she saw a firm's option that allowed stretching the payment over 6 months. She thought, well, let's see how this goes, and took out the loan. The installment loan. Ms. Pazer, a 39-year-old web designer in Santa Rosa, California, has signed up for 5 Affirm financing plans since 2017 to buy woodworking tools, a gel to help with joint aches, and other items. She recently paid off all the loans. Good for her. Some installment options don't charge interest. This article is a month old, 2 months old. It was end of September. The article that just came out for Bloomberg at the end of October, much, much worse. I'll talk about that another minute or two. Almost done with this article. Some installment options don't charge interest. Yeah, the interest levels are not only usury, they are at loan shark levels. Afterpay allows shoppers to divide purchase items into 4 payments that are typically deducted from the customer's debit card. Though it doesn't charge interest, it does assess late fees for missed payments. The Australia-based fintech company has partnered with more than 6,500 U.S. merchants since entering the U.S. market last year. The rest of the article I will attach a link to. Let me get to the Bloomberg article because this one is a lot more devastating. So the Bloomberg article is America's Middle Class is Addicted to a New Kind of Credit by Christopher Maloney and Adam Temkin from October 29th. The payday loan business was in decline, regulators were circling, storefronts were vanishing, and investors were abandoning the industry's biggest companies en masse. And yet today, just a few years later, many of the same subprime lenders that specialized in the debt are promoting an almost equally onerous type of credit. It's called the online installment loan, a form of debt with much longer maturities, but often the same sort of crippling triple-digit interest rates. Not 18% on your credit cards or whatever your interest rate you're paying, and that's still high. Triple digit. That's over 100% 100% or more interest rates. If the payday loan's target audience is the nation's poor, then the installment loan is geared to all those working class Americans who have seen their wages stagnate and unpaid bills pile up in the years since the Great Recession. This all fits well into my thesis that it's stagflate and tax and lie, and the U.S. consumer is either already tapped out or very, very close to being fully tapped out. A lot of different data points that you could talk about on why the consumer is tapped out. And ultimately, that's going to hurt consumer discretionary companies, a lot of them, unless people find sugar daddies or sugar mamas. Or eventually, they're going to default on these online installment plans. Great Recession in just a span of 5. So restaurants, retail, consumers discretionary, a lot of those guys are going to get hurt badly. In just a span in the near future, in just a span of 5 years, online installment loans have gone from being a relatively niche offering to a red hot industry. Only 5 years. Explosive growth. Non-prime borrowers, so this is subprime, now collectively owe about $50 billion on installment products, according to credit reporting firm TransUnion. In the process, they're helping transform the way that a large swath of the country assesses debt, and they have done so without attracting the kind of public and regulatory backlash that hounded the payday loan. Again, if the government, the regulators are not going to do their job and allow this stuff, and people need more financial education, they need to take personal responsibility, they need to learn to do this stuff on their own, not post dozens of Instagram selfies per day for dopamine hits for likes. Or men spending all this time on sports and video games and chasing girls. You need to take care of your own financial situation first. Accept some personal responsibility. Installment loans are a cash cow for creditors, but a devastating cost to borrowers. There you go. So the banks are going to spend a lot of lobbying dollars protecting this cash cow. For creditors, devastating cost to borrowers, said Margot Saunders, Senior Counsel for the National Consumer Law Center, nonprofit advocacy group, Subprime Evolution, this part of the article. For many families struggling with rising costs and stagnant wages, it's a cost they're increasingly willing to bear. They shouldn't be willing to bear. It's a really dangerous idea. The interest rates are a lot higher than even credit cards. In the decade through 2018, average household incomes for those with a high school diploma have risen about 15% to roughly $46,000. So it hasn't kept up with inflation at all, because I talked about the Chapwood Inflation Index. According to the latest U.S. Census Bureau data available, although if you believe the government CPI, then wages are not getting killed by inflation. But the reality, in my opinion, is otherwise. Not only is that less than the 20% increase registered on a broad basket of goods over the span, but key costs that, so even the government inflation data is saying that wages have not, over the last decade, kept up with government inflation data, because they're saying 20% increase on a broad basket of goods with the government inflation data. So wages have risen 15%, and the official government inflation data has risen 20% in the last decade. But key costs that play an outsized role in middle-class budgets have increased much more. Home prices up 26%, medical care 33%. I think the 33 number of medical care is very, very low. I've heard stories of people in the last 1 or 2 years where they've had a 30% increase in only a year or two. And college costs a whopping 45%. To keep up, Americans borrowed a lot. Unsecured personal loans, as well as mortgage, auto, credit card, and student loan debt, have steadily climbed over that span. We also have the subprime auto loan. Subprime auto loan, I talked about that yesterday. Put a link to that at the end of this video about that show. The subprime auto loan debt, very, very bad. We have the collateralized loan obligation and leveraged loans for businesses. That's very bad. Another bubble. For many payday lenders staring at encroaching regulatory restrictions and accusations of predatory lending, the working class's growing need for credit was an opportunity to reinvent themselves. They saw the writing on the wall and figured, let's anticipate this and figure out how to stay in business, aka moving online, said Lisa Servin, a University of Pennsylvania professor specializing in urban poverty and author of The Unbanking of America, How the New Middle Class Survives. Triple-digit rates. Enter the online installment loan, aimed in part at a fast-expanding group of near-prime borrowers, those with bad but not terrible credit with limited access to traditional banking options. Ranging anywhere from $100 to $10,000 or more, they quickly became so popular that many alternative credit providers soon began generating the bulk of the revenue from the installment rather than payday loans. So this Bloomberg article is a lot more scathing, going into detail about the 100% or more interest rates being charged, whereas the Wall Street Journal article from the end of September is saying that some of these companies are only charging $5 for the installment plans. The installment loans or installment plans. Okay, began generating the bulk of the revenue from installment rather than payday loans. So these payday loan companies have shifted online. So each state regulator will have a lot more trouble regulating them, I would say. Yet the shift came because the regulators are almost always behind the private sector. And then the regulators are going to say, we don't have enough money or resources, but people need to take more personal responsibility. The regulators are not going to solve all the problems. There's people who believe the regulators will. If they had more time, more money, more resources, I can tell you I've met enough regulators and enough regulatory agencies, federal ones here in the U.S., especially right outside of the D.C. metro area, that the regulators are not going to solve the problems. People need to solve the problems themselves. All the solutions to all the things going on now, the governments, both political parties, are not going to fix things. The solutions have to be done from the bottom up. They're going to be done. The government's probably going to, almost definitely going to make things a lot worse before things get better. People are going to have to solve solutions themselves from the bottom up at the grassroots level. Yet the shift came with a major consequence for borrowers. By changing how customers repay their debts, subprime lenders were able to partly circumvent growing regulatory efforts intended to prevent families from falling into debt traps built on exorbitant fees and endless renewals. Whereas payday loans are typically paid back in one lump sum and in a matter of weeks, terms on installment loans can range anywhere from 4 to 60 months, ostensibly allowing borrowers to take on larger amounts of personal debt. In states such as California and Virginia, interest rate caps enacted years ago and meant to protect payday borrowers only apply to loans below $2,500. For subprime lender Enova International, outstanding installment loans averaged $2,123 in the second quarter versus $420 for short-term products, according to a recent regulatory filing. Larger loans have allowed many installment lenders to charge interest rates well in the triple digits. Wow. In many states, Enova's net credit platform offers annual percentage rates between 34%, which is about double what a credit card is, and 155%. That is nuts. In fact, Virginia sued NetCredit last year for avoiding state interest rate caps, while California Governor Gavin Newsom earlier this month signed into law a measure capping interest rates on loans between $2,500 and $10,000 at 36% plus the Federal Reserve's benchmark currently at around 2%. Yeah, that's not consumer protection. California is so corrupt. So much waste, fraud, corruption, and abuse. I grew up in California. I don't think I would ever move back. There would have to be so many radical changes. A representative for Enova directed Bloomberg to the firm's latest quarterly filings, wherein the company says that Virginia's claims are without merit. The benefits of installment loans is you have more time to make the payments. Yeah, well, the size of the total amount you owe grows exponentially. The downside is the payments on these high-cost loans go exclusively towards the interest, possibly for up to the first 18 months. Wow, so you're only paying interest. You don't even get to pay the principal back. See, this is why you need a financial education. If you don't have a financial education, you're not going to understand this. The person's going to go and say, I made the payments, but the payments weren't for the principal. They were only on the interest. So the size of the principal kept growing. If you don't have a financial education, you're not going to understand this. The National Consumer Law Center, Sanders said, the industry for its part argues that just as with payday loans, higher interest rates are needed to counter the fact that non-prime consumers are more likely to default. Between Enova and rival online lender Elevate Credit, write-offs for installment loans in the first half of the year averaged about 12% of the total outstanding loan amount, well above the 3.6% of the credit card industry. So I also have on your screen there, and you can see this, I have on my screen that only in about 4 or 5 years, the total loan volume of these online installment loans has gone up almost tenfold. Enormous. Okay, with high-cost credit, You're only serving people that won't qualify for other types of credit, so you're already in a hardship situation, said John Hecht, an analyst at Jefferies. Companies have to price for that. Yeah, but the default rate's going to continue to climb. According to Elevate's most recent quarterly financials, net charge-offs for their Rise installment loan product equaled about 45% of the revenue those loans generated. Charge-offs, I guess that means default rate now? By the time they get to be our customers, they may have hit that speed bump at least once. Often they will run into medical bills or job loss, which knocks out their ability to get other forms of credit, said Jonathan Walker, who heads Elevate Centers for the New Middle Class Research data gathering unit that analyzes the borrowing habits of the more than 150 million Americans without prime credit scores. You know, all these things, subprime auto loans, this new online installment credit bubble, which is starting to grow exponential in only 4 or 5 years. The growth rate it's at is insane. You know, all these things are not sustainable. I don't know exactly when the subprime auto loan bubble is going to pop. I don't know when this bubble is going to pop, but none of these things are sustainable. This is exactly like the credit bubble with the subprime mortgages, the ninja loans, no income, no job, no assets, the stories from the Michael Lewis book, The Big Short, you know, about people in Florida there was a story of like the stripper in Florida who owned 13 houses. There's a ton of other stories. You know, it was not sustainable. It was talked about in the movie, in The Big Short. We're getting to that point again with all these different credit bubbles. Okay, Elevate's average online subprime installment loan customer has an annual income of about $52,000. About 80% have been to college, 30% own a home. More than 10% of the company's core customer base makes $100,000 a year. If you're making $100,000 a year, why are you paying this type of interest? It doesn't seem that smart. I mean, I guess they're good at, if they're making that type of money per year, you'd think that they would have some type of common sense or some type of education to figure things out. But I guess if you have a lot of skill in one industry or talent, you might not have the personal finance. This is why people need a financial education. You can make a lot of money in one business. Look at professional athletes. All these professional athletes who a couple years after their playing career is over, they go bankrupt. They shouldn't. Look how they made millions of dollars, even after taxes. They should have saved plenty of money. And yet you see all these stories of professional athletes making $50 million, $100 million, and a lot of them end up bankrupt. 10 years ago, it was payday loans or nothing, and today there's been a lot of innovation, financial engineering, to meet the consumer where they are. Booming business, the surging popularity of online installment loans combined with a growing ability to tap into big data to better screen customers. I don't believe that customers are being better screened. I believe they're claiming they're being better screened. I think I talked about this yesterday on the subprime auto loan. The company CACC, the Consumer Subprime Auto Loan Company, where the stock price in the last 10 years has gone from like $33 a share, almost to $500 a share, and they've been growing the amount of their loan base like crazy, and they were claiming that their loan default rate was way below the industry average. I think there was red flags there. There's no way that you can claim that you're doing better research on loan defaults and issuing more and more subprime auto loans. That's not sustainable. Okay, now it's gone on longer than people have thought, but at some point there's a limit. You can't keep issuing subprime auto loans and growing your loan book and saying your loan default rate is low. It just doesn't make sense. Because with the subprime auto loans, people just making the payments, not paying off the principal, barely making the payments. I mean, there's going to be a lot of repossessions and defaults. Okay, the surging popularity of online installment loans combined with a growing ability to tap into big data has helped boost the fortunes of many subprime lenders. The Trump administration's decision earlier this year to delay and potentially weaken planned restrictions on payday lending, announced in 2016, has also bolstered the industry's outlook. Elevate's annual revenue rose about 1,000%. Wow. Annual revenue rose 1,000% in only 5 years. While Innova has seen growth of 46% in 5 years to $1.1 billion. According to data compiled by Bloomberg, subprime installment loans are now being bundled into securities. Oh no, here we go again. The same junk as Mortgage-backed securities, MBS, the same collateralized mortgage obligations, the same junk as leverage loans and collateralized loan obligations. Subprime installment loans are now being bundled into securities for sale to bond investors and pension funds, providing issuers an even lower cost of capital and expanded investor base. Oh my God. This is so predictable. It's so tragic. It's a bug in search of a windshield. Earlier this month, Enova priced its second ever term securitization backed by net credit loans. The deal paid buyers yields between 4% and 7.75%. This goes back to the central banks, the Federal Reserve and all these other central banks. These governments need financial repression, and so everyone's desperate for income. Governments can't afford to borrow at high interest rates. Central banks monetize debt, increase their balance sheet. Central banks manipulate interest rates lower. In the European Union, they even have negative interest rate policy, so these governments don't have to cut back on their budgets. And this causes the unintended consequence of starving retirees, pension funds, savers for yield. And then you have people reach for highly, highly risky things, desperate for income, desperate for yield. People taking all kinds of risks for this 4%, between 4% and 7.75%. So the riskiest of the risky of these subprime installment loans are packaged together, yielding 7.75%. And just like subprime mortgage-backed securities, where these things were probably rubber stamped, the ratings agencies are probably also involved, and these things could go to zero too. Its debt asset-backed security issued a year ago contained loans with annual interest rates as high as 100% for this company, Nova. Bulk of the growth fueled by middle class. About 45% of online installment borrowers in 2018 reported annual income over $40,000, according to data from Experian. Their Experian's Unit Clarity Services, which is on also cited in that chart there, based on a study sample. Clarity is the one who did that chart, I believe, that I have there on your screen. Based on a study in the Bloomberg article here, based on a study sample of more than 350 million consumer loan applications, 25 million loans over the period. Roughly 15% have annual incomes between $50,000 and $60,000, and around 13% have incomes above $60,000. For Tiffany Poole, a personal bankruptcy lawyer at her firm in Delaware, Middle America's growing dependency on credit has fueled a marked shift in the types of clients who come through the door. When she first started, most filings were from the lower class, but now she has people who are middle class and upper middle class, and the debts are getting larger. So, for bankruptcies, said Poole, who's been practicing law for 2 decades, generally the debtors have more than one of these loans listed as creditors. Ooh. Okay, so that's it for the article. So sad. Thank you for the super chat. Toast Bill Clinton. I won't make a political comment on that. TVIX. I haven't looked at that symbol. I don't know it offhand. JJW. I think this is part of human nature. I think people they have to have it now, and they're desperate. It's a combination of things. People are desperate to maintain their standard of living, and then people also, they see all these lifestyle things on Instagram and Snapchat, all this social media stuff, and they get jealous. But what are the people doing on Instagram and Snapchat to get those vacations where they're, at a 5-star resort? I mean, I've heard some of the stories. There's a video going around. I can't talk about it because this video will get demonetized if I talked about it. But there was a sugar baby video that just went around the last 48 hours, and it was so bad. She filmed her sugar daddy in bed with her. It was really gross. I can't believe that she did that. It was really disrespectful. Apparently, she's a well-known sugar baby. So for her to get those expensive vacations, all the nice clothes, she filmed what she was having to do to get it. You want to know what TVIX is? Since you gave me a super chat, let me look it up on Yahoo Finance. Give you a quick opinion. Okay, I absolutely hate, it's TVIX. is Velocity shares daily 2 times VIX short-term exchange traded note. I absolutely hate these leveraged ETFs. Absolutely hate them. I don't trade these things. This is not financial advice. I tell people to stay away from these things. They're only meant for day traders. And why would you... Is this shorting the VIX? Or is this going long the VIX? 1 second. Where's the explanation of what it is? The investment seeks to replicate, net of expenses, the returns of twice the daily performance of the VIX Short-Term Futures Index. The index was designed to provide investors with exposure to one or more maturities of futures contracts on the VIX, which reflects the implied volatility of the S&P 500 index at various points along the volatility forward curve. The ETNs are linked to multiple 2 times of the daily return of the index and do not represent an investment in the VIX. Okay, so it's a double leverage one. I think it's on the long side. I don't think it's on the short side, but the VIX, look, the VIX is just hammered. My buddy Adam Tumerkin, he was talking about how on the commitment of traders on the VIX, the amount of shorts on the VIX has exploded. So people have doubled down shorting the VIX. Oh, you like how the funny voice that I read that in? I practice reading my super fast lawyer voice, like what they say on the commercials, but I don't think I'm gonna do that yet on a podcast. The VIX has been smashed down. My buddy Adam Tumerkin, you can follow him on Twitter. He's a speculator and he tracks this stuff. The commitment of traders' position in the VIX has increased massively to short the VIX, betting that the central banks, are stepping up with the balance sheet size. I don't like these leveraged ETFs, any of them. I don't like any of them. I would stay away. If I was managing money, this is just my opinion, hypothetically, if I was managing money, I'd probably be buying out-of-the-money VIX call options because they're cheap. Because the VIX is smashed back down to 12.07. It's down. It was down over 5% on Friday. It's probably cheap again. But it's the whack-a-mole. I've talked about this. Wall Street does not want the VIX going up permanently a lot. So when it pops a lot within a couple days or a week, it could be right back down again. There are so many people. The size of this leverage short volatility trade is well over $1.5 trillion in size. Christopher Cole, Artemis Capital. Listen to his 3 or 4 interviews on Macro Voices. Sonny says being short the VIX won't work forever. I totally agree, Sonny. However, when the hedge fund that blows up shorting the VIX, it will be as bad or worse than long-term capital management. And I've heard some stories out there that there are some very large hedge funds that are short massively the VIX. So I've talked about this for years. There's another long-term capital management out there, and one of the dumbest trades these hedge funds have done is leverage short volatility, not on the VIX and elsewhere. There will be another long-term capital management at some point. For what we know in Repo Madness, there could already be one. People need to learn financial education. Finance Freak says payday loans should have always been predatory. Usury loans should have been capped, but that's life. Yeah, I mean, the banks have so much control here in DC. I've spoken off the record with a banking lobbyist years ago. The bank lobbyist told me it's all fiat money. There's going to be tons of credit bubbles. Nothing's really going to get changed until the dollar blows up and the U.S. loses world reserve currency, sole world reserve currency. That was directly off the record from a bank lobbyist that I spoke to about a year or two after the 2008 financial crisis. The banks control both political parties for the most part. I think Bill Gates even said that he would vote for the other candidate instead of Elizabeth Warren. Okay, well, that's it for this that's it for this short show. I want to thank my almost 200 Patreon account contributors, my dozen or so monthly PayPal account contributors, and the people chip in once in a while. Much appreciated. You're taking a lot less stress. You're taking a lot of stress out of my life and allowing me to focus on quality content and growing my small business here and providing the absolute best information, education, research, and analysis out there about investing in the economy. So just another credit bubble, and it's only been created in the last 4 or 5 years. Welcome to dystopia, right?